Well, good afternoon, everyone, and welcome to IMFG's webinar, Perspectives on Markets and the Federal Budget. We know how precious your time is. We know it's also something you can't make any more of. So on behalf of all the team at IMFG, we really want to appreciate and thank you for coming along. We know you've taken time out of your day to be with us. My name's Dan Blatch. I'm one of the directors here at IMFG, and I'll be your host today. Some very quick housekeeping. You'll note that your camera and microphone have both been disabled. That's intentionally, not because we don't want to hear from you, but just in the interest of continuing to run a smooth meeting. However, you'll note the Q&A function is available to you. So we would encourage that you do drop us a question and we will endeavour to answer as many as we can, time permitting. If we don't get to answering your question in the live webinar, please be reassured we will come back to you. The private client advisor and their team will certainly address them for you. Everyone will get a copy of today's recording, both the slides and the webinar. So please, even if you happen to have registered and not being able to attend, you'll get a copy of that. I do have to provide you with a disclaimer, and that is that all information in today's webinar will be of a general nature. Please don't act on any of it until such time as you've consulted your IMFG private client advisor or your tax advisor. We have a very ambitious goal today of trying to fit a lot into 30 minutes, including some questions. So you will hear from us across two key areas. We've got the good fortune of Dr. Steve Garth, Independent Chair of IMFG's Investment Committee, joining us and shedding a light on economic and market updates. And then that will be followed by Angus Dockrell, Director and Wealth Specialist at IMFG, to provide some perspective and light on the recent federal budget. And we do all of that knowing that your concerns are of utmost importance to us. And we know that all your key concerns around preserving and growing your wealth, minimising your tax, protecting your assets, taking care of your heirs, and of course, increasing the impact for charitable giving. So two of those, especially today, will be the focus of Angus's presentation. It's almost impossible to not hear the word oil in any news bulletin today. And so on that note, I'll pass over to you, Steve, to talk through us your economic update.
Yeah, thank you, Dan, and welcome everyone. It's a great pleasure to be here. I'm going to give you a lightning quick review of what's been going on in the last couple of months in financial markets. And as Dan just mentioned, you can't really go past oil. It's all about oil. And you can see in the chart here that oil's kind of been doing nothing for ages. And then suddenly on February the 28th, it spiked up by around 80%. And it's gone up and down since then as there's talk about ceasefires, and ceasefires are ended in the Middle East. But you can certainly see that jump in oil is, of course, what's affecting not only what you pay at the petrol price, but more importantly, it affects inflation overall. Believe it or not, oil is just in about every product that we consume. And so if oil spikes by 80%, inflation is going to be higher. Now, equity markets do not like inflation. And you can see here that in the Australian market, that the volatility is up. You can see there in February, believe it or not, we were hitting new highs on February the 28th. And then it all went a bit pear-shaped with the conflict in the Middle East. But that was due to the sudden bout of expected inflation. And then a bit of ceasefire talk, markets crept back up, and they've kind of gone back down again because there is no ceasefire. Everyone's looking at this to be a conflict going much longer than expected. And even if there was a ceasefire tomorrow, unfortunately, the price of oil and therefore inflation is going to remain high for some time. So while volatility is up, it's not that bad. It's not very much different from what goes on throughout the year. You can see another dip in the markets back in October, in the middle of my chart there. And that actually was due to inflation as well, something I'm going to touch on again in a moment. But in October, way before there was a Middle East conflict and way before oil shot up, Australia got an unexpectedly high inflation print, and though that sent the market down in October. So at the moment, it's a pretty miserable year-to-date number, 0.5%, but still, it's a positive number. And it's not a great number since the end of the financial year last year, 4.1%, but, we've still got plenty of time. So while those numbers aren't great, keep in mind this is very short-term figures, as we'll show you a bit later. The numbers over the last couple of years have been exceptional. So the fact that we're just sort of rocking along a little bit slowly at the moment, probably not that much of a surprise. Now, that's Australia. If I show you the US market, that's a little bit of a different story. While you can see the Middle East conflict and the effect of higher oil prices had the same effect on the US stock market back in February and March of this year, boy, the last couple of weeks, that market has just taken off. So what a comparison. The figures since June the 30th last year is the US market in US dollars is up over 17%. Now, of course, that leads to another worry. What many people are calling is the US market in a bubble. Now, I'm not going to spend any time addressing that here. The thing about bubbles, you actually only ever know that the market's in a bubble after it pops. Trying to predict when that will pop, if it is in fact a bubble at all, is next to impossible. And keep in mind that the big companies that are leading the charge there, the big tech companies, this is not like the dot-com era for those of you who remember back 25 odd years ago to when the internet stocks just went on an absolute price rise, but there were no earnings. The companies we're looking at now, the AI companies, while their prices going up enormously, so are their earnings. So it's not really bubble territory. Not to say that there may not be a correction in the near term, but whether or not it's a bubble, I think that's an open question. Now, we talked about inflation, so let's look at that a little bit more. Now, look, in general, no one ever looks at 10-year government bond yields. No one really cares about bonds until they don't do what you want them to do. And bond yields are very sensitive to inflation. So here's a chart of both Australian 10-year bond yields and US 10-year bond yields. And once again, remember I said that back in October we had an unexpected high inflation print? Well, you can see that in the blue line there. That's the Australian 10-year yield. Look how it jumped up in October. So all this was happening before oil went up and before sort of global inflation really took off. Now, at the same time, the US wasn't really affected by that. Yields went down a little bit as markets were looking good. And then once again, February the 28th hit, oil spiked by 80% and suddenly inflation was on the agenda again. So those charts, well, no one really cares about bond yields. They do tell you a little bit about inflation and market expectations of inflation. Now, it's important to note that at the moment, there's a bit of a tug of war going on between inflation, which is clearly winning, so bond yields are going up. But also, because inflation's going up, it's potentially, and I use the word potentially, slowing down global economic growth. And if it slows too far, we'll end up in a recession. It's a fear here in Australia, but even more generally in the US. If there is a recession, which is a couple of quarters of negative growth, then what you'd expect is not only stock markets to go down, but you actually expect bond yields then to go down. Bond yields are inversely to the bond prices, so you expect bonds then to do their typical role of supporting your portfolios if there's any volatility in the equity market. So keep in mind, while when bond yields go up, bond prices go down, bond yields are at a pretty good level at the moment. So there's decent income coming out of bonds. And what we're really looking at is there's plenty of room for those bond yields to come down and therefore bonds to have exceptional returns should the equity market not behave by keeping on going up and up and up as it has for the last couple of years. Now, let me just finish off and then I'll pass over to Angus. Of course, everyone is interested in interest rates, particularly if you've got a mortgage, but even everyone else is interested in interest rates with even your savings accounts. And it's been a bit of a roller coaster in Australia. So way back in 2001, interest rates were around zero, as the government of the day used a lot of stimulus to get the economy moving with COVID going on. And then interest rates spiked from about 0 to 4% really quickly. Now, you don't see that in that chart. Since 2003, when that chart starts, interest rates went up a little bit, stayed on hold for a while, and then started to come down, to the joy of every mortgage holder in Australia. But remember, I mentioned that inflation spiked before the war. Inflation went up in October. And you can see there that the Australian rates have started to go up even before oil prices went up. So the RBA is a bit stuck. Inflation was already high and the RBA had to raise rates. And now inflation is a little bit higher because of the Middle East conflict. So all these are out of the control of the RBA or the government. The only tool that the RBA really have to try to get inflation back down is to raise interest rates. And so you can see interest rates starting to rise again. That's not the story in the US. US rates went up faster, but have come down more than Australia. They've been on hold for quite a while. Inflation is biting in the US. The US may have to raise rates, although not trying to forecast too far in the future. It's more likely that the US will keep their rates pretty much on hold for a while as that conflict in the Middle East plays out. But Australia, we're probably likely to see another 1 or 2 rate rises this year, and that should be enough. So that's a very quick overview of what's been going on in financial markets. It's all got to do with inflation, that dreaded word. So while the Aussie market's down a little bit, the volatility, while you hear about the Middle East conflict every single day and inflation every day, and, you know, lately, as Angus is about to tell us, the budget every day, the volatility in the stock market is not unusually high. It's kind of a fairly typical that happens a couple of times a year. With that, I am now going to hand over to Angus.
Well, thank you, Steve, and thank you to all joining. There's lots to unpack with last week's federal budget. Whilst there are a number of economic, business, political aspects to that federal budget, I'm going to focus my presentation on the personal impacts to you and your financial plan. And last week's budget on that score confirmed what had really been coming or been building for some time, and that's a fundamental shift in aspects of the Australian tax landscape. If you will, a recalibration back towards taxing more wealth more effectively. And in some ways, narrowing the strategies that the everyday Australian has to minimise the impact of tax. Implications are quite straightforward. 3 of the more commonly used tax strategies that clients have been deploying for quite some time are having some significant change, whether that be negative gearing on residential property, on capital tax, and on the taxing of strategies to avail to minimise the impact of tax are narrowing, as I said, but I note 3 things before I get into the crux of the presentation. Firstly, these budget proposals are not yet law. That is, you've got time to wait until the political class put these proposals into law before making significant changes to your affairs. Given most of the proposed changes don't take into effect for at least another 13 and a half months, if not the year after, 1 July 2027 or 1 July 2028, there's also going to be plenty of time to adapt. Secondly, my second comment would be there is some wiggle room. I think this government and some governments in recent years have, without getting political, telegraphed some policy changes and allowed time for proposals to go into law. And one example that comes to bear, I know there's a lot of worry about these tax changes, but one example comes to bear is the proposed change of Div 296 super tax for those with more than $3 million. those proposals of 3.5 years ago, what was proposed is very different, or actually has been walked back considerably than what's actually been enacted and coming into force in the 1st of July this year. So in some respects, there is some scope that perhaps the political class have some wiggle room between what they propose and what they enact. But in any event, still time to react and adapt. And in that regard, and the third stream of what I'd perhaps just pass on is one of the benefits of working with us is that we help continue to make help you continue to make wise decisions on your own financial future. And I guess I will just close that these tax changes, some say are large, but that is, change is normal and the well-advised investors adapt. Negative gearing. This is reasonably well publicised, impacting residential property investors only. For properties which commence to be held from budget night, and with effect from the 1st of July, negative gearing of a residential property will be limited to new builds. And so that has a significant effect of removing a lot of the tax benefit for a significant portion of Australians investing in property, certainly residential property. Interestingly, it's not impacting other investments. So negative gearing continues to be an effective strategy for those investing in shares, as well as other forms of property, commercial property, industrial property, retail property. There is some transition here over the next 13.5 months, but I would suggest, without going too deep into it, that aspect is something you should work with your advisor, both here at IMFG and your tax accountant, over the next 14 months. And in some respects, it takes some of the demand away from the residential investment market, which arguably is what the political class are wanting. Second big change, and this one impacts most Australians, and that is changes to capital gains tax. What is old is new again. In some respects, they're replacing the current 50% discount with what used to be the case prior to 1999, that is indexing one's cost base. So that the government is saying, moving forward from 1 July 2027, for those who are wishing to invest for their future, that they will be taxing that capital growth that you enjoy only on the real gain after inflation, as opposed to perhaps arguably the more generous 50% discount. So that is quite a significant change, impacting many people. There are a couple of stings in the tail with this one. For those, well, far-sighted enough to have invested in assets and held them for the last 41 years, those would be well aware that assets at 1985 are capital gains exempt from tax, but they will be caught in the tax net from a capital gains perspective from 1 July 2027. And I guess this other concept, which may present some cause for grief, particularly for low-income earners or those that with good planning are in retirement or about to retire and are therefore on low incomes, there's a minimum 30% tax on the assessable gain. So that coming into play from 1 July 2027 may cause the low-income self-funded retiree to reflect back on whether it makes sense to rearrange their affairs before 4 July 2027. Good news, though, on the capital gains tax front, no change to the main residence exemption, no change to the small business capital gains tax concessions, and also good news, didn't really get much news, no change to how superannuation funds are taxed on capital gains tax, and little known fact, they have a discount of sorts, which will continue on. So superannuation funds are exempt or not caught up in these changes. Changes, this will get a lot more political commentary, I suspect, beyond what's already played out in the last week, and that is changes to taxation on discretionary trusts. And this impacts small business owners, It impacts professionals. It impacts many, not all, but many high net wealth families, where we're changing the taxation of, or the government are changing the taxation of discretionary trusts. There are some exclusions, of course. Those special disability trusts, primary producers, so farmers, thankfully, are excluded from their primary production income. It also excludes super funds and some charitable trusts. But the main vehicle for the small business or professional or many high net worth families over the last couple of decades of housing assets through a discretionary trust. There are two real main reasons people do or employ discretionary trusts. One is around tax minimisation or deferral or smoothing over their lifetime or the lifetime of their families, or asset protection. And clearly these budget changes do not change the asset protection nature, but they do change the taxation benefits of these structures. This one is not impacted until the 1st of July 2028. So it's a little bit more than 2 years before this comes into play. So plenty of time to consult with us, working collaboratively with your tax accountant to, if you are in these impacted by these changes, to rearrange or explore how one can adapt to the emerging and new world. But again, devil in the detail, and I would not be making any changes at this point until we have clarity on what the LAW law is. And again, these changes don't come into place for a couple of years, so plenty of time to work with your professional advisors to adapt. Other tax changes in the budget. There are a couple of other tax changes that you can't really do anything about, but I'll just note, and in some ways they play into the general theme of the government's view of striking a fairer balance of how they tax wealth rather than just taxing salary in the working class. And in some respects, some of these tax changes reinforce that recalibration. There is the WATO, the Working Australian tax offset. So if you're a working Australian, you're going to get a $250 tax offset. If you're also working, you will generally benefit from a $1,000 straight tax deduction. That's going to come in soon. On the other hand, the self-funded retiree is being asked to pay a little bit more with their private health insurance, with that rebate unwinding soon. Beyond that, I think those three large tax changes are a structural change. I would just suggest and remind ourselves beyond the time that well-advised investors adapt to whatever change occurs. And with that, I'd also like to perhaps remind that it's not part of this budget, but it's very close to being finally implemented, and that is for a few of them on the call impacted by Division 296, that is that superannuation additional tax for those over who have, through good fortune and a lot of sacrifice, more than $3 million in super. That additional tax comes into play in 1.5 months, in the 1st of July 2026. Many of those are well advised on that, but it's again another reminder of that that change, that additional tax, is ended up a lot different and arguably less egregious than what was originally proposed, and perhaps some aspects of these budget changes may be wound back or walked back in time, but who knows. With that, I might throw back to Dan and perhaps open the floor for any questions that have come through.
Yeah, thanks, Angus, and thanks, Steve. Great summary. Steve, there was a question that's just come in for you. We have got time, so we've done well here. It said, how has the budget in general affected markets, and how over time has that been the case? Steve, one for you. You've got yourself on mute there, Steve.
How about that?
We've got
Actually,
you.
Normally people can hear me even when I'm on mute because I've got such a loud voice. But that's a great question. Thank you, Dan, because As we know, there's a lot of smoke in the media, particularly around the budget. It's really, I was talking about all the noise around the Middle East conflict. Well, the budget has certainly dominated. But I think Angus really did that well to start with, to say that the budget is, how does it affect you personally? And that's the same with financial markets. Believe it or not, the financial markets don't react to budgets because it's a very personal thing. So while some people will gain from the budget, some people will lose. Some of the media will say this is the worst budget of all time. Other media says, you know, it's fine, it's a good thing. You know what? Financial markets ignore all that because it's very personal how it affects people. It doesn't affect the overall market. And in fact, Dan, just on that, people also think that elections affect financial markets. You know, this is going to be the best government ever. Everything's going to be rosy under this, or this is going to be the worst government where, you know, we're all going to go to pot if this government gets elected. It makes no difference. There was an analysis done in the US where under every president ever elected, the stock market's gone up. And I'm pretty sure you would find the same under every Australian government, Liberal or Labor, markets go up in that period. So budgets affect people personally, no question, and Angus really did that well, but they don't affect the overall market.
Thanks, Steve. And Angus, this one's for you from Anne. What impact do you think the budget will have on superannuation?
Well, the good news is none directly from the budget. There might be some indirect small things down the track, but the good news is super is largely untouched through this budget. It remains the most tax-effective environment for you to build and maintain one's wealth, certainly up until $3 million. And so, yeah, it was good news because there was scuttlebutt, particularly around capital gains tax and other things, but that has all been unchanged.
Thank you. Steve, one for you from Robert. We can't help but hear about inflation. What impacts do you think that will have on the budget? Will it help or hinder the Reserve Bank's fight against inflation? Regular on every news bulletin, Steve.
Yeah, this comes back to my point. It depends which media outlet you're reading about the effect it will have on inflation. And in fact, it depends on which economist you talk to. So it's a great question, but there's no clear answer to that. Now, the government are as painfully aware as everyone else that there are cost of living pressures on people, which have been amplified by the conflict in the Middle East and the rise in oil. So on one hand, they want to give cost of living relief to some people, and they've done that through a short-term fuel excise tax relief. But that in itself is inflationary. So they've made that very short. It's a very short-term thing. So, you know, does the budget increase or decrease inflation? I think that the government is painfully aware that inflation's high and that the RBA are going to have to increase rates anyway. They really don't want to do anything that changes that narrative. So it's a bit of a woolly answer. Different economists will have different views. The answer is probably not much because the government is aware that inflation's high, and they certainly don't want to make it any higher if they can avoid that.
No problems. And just one last one, because we do have a 1 minute here, Angus. Bit of a curly one for you. At the risk of getting political, what do you think the budget will it in any way shape or inform / change intergenerational inequity? Do you have a view on that? Is this a bit political, Angus?
Look, I'm not going to get into political talk, other than the general comment that if you have political capital, spend it wisely. You know, they're talking notes of all these changes that they're throwing at housing affordability, and to create 75,000 new homes over 10 years. You know, the bang doesn't match the buck, but I think the clues are politics aside, whether you're red, blue, or indifferent, or green, orange, and all the others. is that this is a debate around what type of society we want, and there is an emerging view of many people across all that spectrum that capital versus labour, capital has won over the last 40 years, and a recalibration of the tax system to potentially recalibrate and ask more of taxing of wealth and potentially less over time of salary or worker or labour seems reasonable, to be honest. Yeah.
Yeah, thanks, Angus, and thanks, Steve. In the interest of time, I will wrap up and close. Appreciate everyone jumping on the call today. I hope you took something out of that. It is a gentle reminder that the only constant in this world is change, and we stand ready to assist you both today and ahead of your next progress meeting with any questions and fears, concerns you may have. By way of reminder, the service is designed to provide us with three things: provide you with clarity, knowing that you've got a team on your bench to assist with any of these changes, provide you with confidence knowing that they'll actually happen, and of course control to make sure that we can adapt your plan as we go along. So you will get a copy of this recording plus a follow-up email by close of play today. We thank you very much for coming along, and I can see now that the sun is finally out here in the Sydney sky. So good afternoon, and I hope you get to enjoy it. Thanks for joining us.